Germany underperforms, but are recession fears warranted? Welcome to Market Insights. I'm Peter Devlin. Europe's largest economy started the year on strong footing, but it has struggled to maintain that momentum. Recent indicators have signalled a weakening mood, especially in the manufacturing sector. The IFO expectation index slipped for a third month in August, warning that Germany is falling into a crisis. So is Germany the sick man of Europe, and how will this play into the central bank picture? To help answer that and more, I'm joined by James Smith, developed markets economist at ING. Welcome, James. So we look to the flash CPI prints due out from Germany on Thursday. So will we be seeing further signs of endless stagflation?
I think stagflation is very much the word of the day. I mean, the economy, as you mentioned, is still under a lot of pressure. Clearly, it's one of the weakest in the Eurozone right now. But having said that, one of the sort of standout positives in the German economy right now is the jobs market. And that's been true across Europe for the last few months, or the last couple of years. In fact, the jobs market in general across Europe has stayed more resilient than we've seen in some other places. Now, having said that, the German unemployment rate has begun to creep a bit higher. But at the same time, unions in Germany are making very big pay demands, 7% plus as we go into the autumn. So it's a complicated picture for inflation. On the one hand, growth is weaker, but equally, as I say, there's still these big wage pressures coming through.
So over to the Bundesbank as well. They're still seeing expansion in the third quarter for Germany on stronger spending. So can we depend on the consumer?
The consumer is still pretty pessimistic about the situation. I guess everyone can see Germany's economic challenges right now. I think the more interesting question for the latter half of this year is what happens to industrial production. Clearly, a very important question for Germany. It's been struggling under the weight of weaker Chinese demand, but also the competitive nature of Chinese electric vehicles as well. Inventories are very high right now in the industrial sector in Germany, as they are across Europe. If that situation begins to turn, if demand begins to pick up for German products, then potentially that's where the green shoots begin to come in. But otherwise, I think it's that stagflation word that's still very important.
James, you touched on that industrial data print now, and the gloomy PMIs also offering a bleak reading. So how bumpy will an economic recovery be?
Well, potentially quite bumpy. As I say, there's a lot of things going on. In the short term, of course, inflation is down. And as I say, wage growth is, or at least wage demands from unions are still pretty high. So from that perspective, maybe that offers a bit of hope for the consumer. But I think there's a longer term story here for Germany, which is not a particularly positive one. As I mentioned, there's that interlinkage with China, which is still sort of a big weight. Also, the loss of sort of cheap energy as well is sort of really fundamentally changing the nature of what Germany produces. So it's going to be a challenging outlook, and hopefully maybe a bit of a rebound in the second half of the year, but we're not getting too excited just yet.
So again, back to that German labour market you touched on. We saw a drop in headline Eurozone wage growth as shoring up bets of a cut in September from the ECB last week. Overall underlying wage growth in Germany did actually increase. So is the ECB willing to look past Germany?
I think in the short run it is. I think you'll probably look at the overall Eurozone figures, that headline number for negotiated wage growth, which did come down, as you mentioned. I think that's probably just about enough to unlock a 25 basis point rate cut at the September meeting. But the story in Germany, it does feed into this idea that wage pressures are more persistent than the ECB would like. Potentially at the September meeting, we see the ECB upgrade its forecast for wage growth at a time where, of course, growth is disappointing as well. So there's a bit of a balancing act. But yeah, I think wage growth is one of the really key, if not the most important thing the ECB is watching right now.
So finally, those flash Eurozone CPI prints for August are expected to fall further on Friday. So can anything derail a 25 base point cut in September?
I think it's probably would take quite a big upward surprise to inflation to derail a rate cut, but it's still going to be very important. I think one of the interesting things when you look at Eurozone inflation is that services inflation has been pretty much stuck around 4% for getting on for a year now. And this is one of the main concerns for the ECB, and those concerned about wages feed into that as well. I mean, at headline levels, the story should look better. Petrol prices are at their lowest level, I think, for at least year to date. So that should help the headline number come down. But core inflation pressure still very much there. So, the ECB still treading quite cautiously for now.
James Smith of ING, many thanks for your thoughts. And that's Market Insight. Don't forget, you can watch more videos on Reuters.com.